All right, we welcome you back. The mood is a cautious one on this Thursday in trading. We are seeing oil prices under pressure. We mentioned financial stocks struggling after some worrisome numbers in the eyes of the market from the likes of JP Morgan. Let's bring in Theoret, who's a global macro strategist at Manulife Investment Management. We can't ever take a breather here, Eric. I mean, we could have a conversation around what the Bank of Canada did yesterday or the inflation numbers yesterday in the U.S., but we've had to move on to more data. And it almost feels like a market that is like a chicken with its head cut off, running around, looking at this, looking at that, trying to make sense of it, and most of the time erring on the side of caution, like sell now and ask questions later. What's your general sense of the mood right now?
Well, I think you've characterized it pretty appropriately. I mean, considering the Bank of Canada's surprise decision yesterday, the Fed expectations now moving towards a 100 basis point hike at the next meeting, and concerns about other central banks not even being able to meet the pace of tightening that's being set by these North American central banks is really quite a concern for markets. And so we are seeing risk aversion across asset classes in FX as well, with the US dollar strengthening broadly against all of the G10 currencies. And so on a regional basis, we do see the US outperforming in terms of sector allocations. We see defensive sectors outperforming, and it's very much a risk-off environment.
So let's talk a little bit more about that strategy, because I think anyone who watches all the time here at BNN Bloomberg, they've heard the headlines and they've seen the sour sentiment. But in terms of portfolio strategy with that bear market in the U.S., you're still seeing opportunities in that market. It's just that you're saying you're leaning towards defense.
Well, absolutely. And I think, the way I'm speaking about this is, of course, on a relative basis. And so when we look globally around the world, emerging markets are really struggling within the context of China's zero COVID policy. Europe is really struggling within the context of their energy shortage and the supply issues that they may be facing in the second half of this year. And so on a relative basis, the U.S. is still a very good home for investors as we look into the back half of this year.
As you're saying that, I am curious what you think about Canada by comparison. And we spent all that time in the first half talking about how the fact that we had more of that skewed towards commodities would maybe be something that allows for Canada to outperform. Indeed, that was the case in the first half. But I was even just talking about that weakness we're seeing in oil today. It's really getting complicated for investors. They heard all about supply shortages. They heard about the geopolitics playing into the favor of all of the commodity trades that in many ways represent Canada. But now that we've moved into a deeper conversation around recessions, we're really seeing investors quite quickly move away from that trade.
Yeah, absolutely. I think, the first half of this year was obviously characterized by impressive performance in terms of energy and materials, things that really benefit Canada. And so as we move to the second half of the year and central banks really start to get this inflation situation under control, those are the pieces that are going to weaken. And we've already seen a pretty dramatic pullback in terms of both energy and materials. So Canada is starting to suffer. And you really need only look at the currency to see, that weakness really materialize. We've got dollar Canada now hitting fresh highs. And I think as we move through the second half of the year, we could probably go to the mid-upper 130 levels for dollar Canada.
And why don't we spend a beat on that as well? What would you say to our audience about the dynamics in the currency market, which I think are important too for investors who, we talked about safety. You look at the price of gold. Gold has not necessarily performed the way some might think, given the headlines they're reading. But I think in many ways that's because the big safety trade of the year had been the U.S. dollar. And if I can add another point to this, very busy time we're living in, we've been talking so much about parity with the euro. It wasn't that long ago that the euro was much stronger against the greenback, but because of the woes for the European economy and where the ECB is at this point in the rate hiking cycle versus the U.S. Fed, it's been easy for investors to gravitate back towards the U.S. dollar.
Yeah, absolutely. So I think if we focus back to Canada, I think there are two things that I really want to keep in mind is that Canada's outperformance on a relative basis is really impressive year to date. Obviously, energy was a big help. And so Canada actually, kept its strength relative to other G10 currencies quite a bit more through the start of the year. Now, as we've seen this weakness in materials and energy, we are going to have a bit of a catch-up trade. And I think there will be a period now that we're facing where Canada will actually see a more accelerated pace of weakness in terms of the currency as it catches up to the weakness that we've seen across other major currencies. To speak to the euro, which you just mentioned, hitting parity, that again is an outlook for relative central bank policy that sees the Fed really dedicated to a tightening cycle, and an ECB that has yet to even start in terms of rate hikes. So we do have the ECB next Thursday. A 25 basis point hike is expected. But again, that's out of deeply negative territory, really moving from negative 50 to minus 25. So there's quite a bit of, I think, in terms of expectations for the ECB, quite a bit to meet that it's not likely to be met in terms of tightening. And that's why we're seeing some of that weakness in the euro specifically.
Just before I let you go, with it looks like WTI prices for oil right now at their lowest level since Russia's invasion of Ukraine began. We have spent already over the last 24 hours a lot of time assessing inflation, whether it's the U.S. or Canada, because of the Bank of Canada decision, because of the latest inflation numbers. And we are constantly reminded by the experts that as much as the Fed and the Bank of Canada can cool off demand through higher rates, and they can control some of those key components to core CPI, that there are wild cards like food and oil in this trade. Now, when we see oil quickly approaching $90 a barrel, as complicated as markets are, can we make an argument that food and oil prices possibly may not be as elevated as they had been as you go through the rest of this economic transition, if you will?
Well, I think, what we're seeing in terms of the energy market is precisely what you're talking about. Central banks have tightened, growth is expected to slow, and commodities are adjusting. And so I think this is all part of the process that central banks are trying to achieve in terms of getting inflation down. And a key component of that is the price of energy. So the weakness in crude is actually desired by central banks at this point, given how important it has been for this latest uptick in inflation that we've been seeing in the headline figures.